Welcome back, everyone. I hope you're having a great day. And in this episode, we're going to take a look at 4 growth stocks to keep on your watch list for the upcoming trading week. And all 4 companies we're going to go over are leaders in their respective industry and have a ton of potential to continue to grow over the longer term. And over this next trading week, all 4 companies have a major news event coming out. Whether it be an earnings report, an investor presentation, a new product launch, there's an event coming out for each of these companies over the next few days that will definitely impact their share price, which may create some great buying opportunities. So in this episode, we're going to take a look at all 4 companies in a bit of detail, going over their recent financial performance and the future growth expectations. But before we can jump into that first company, I'm going to ask you to please hit that like button and subscribe. I'm the Gen Z investor, and every single day we talk about the stock market, going over different stocks you can buy and any major market news. So please hit that like button, subscribe for the daily videos. And the first high growth company we're going to take a look at today is ticker SHOP, which is Shopify. They trade for $1,473 per share and have seen incredible performance over the past 12 months, growing by over 60%. And a point I want to make very clear at the beginning of the video is that I understand that a couple of the growth companies we're going to take a look at in this episode are trading with very high multiples and very high forward PE ratios. But these are some of the fastest growing companies on the market, so you are going to have to expect to pay a premium to get the growth that these companies are expected to return over the next 5 to 10 plus years. And also, right now, the market is still trading at all-time highs, and we're in a very overvalued environment. But if you're still looking to buy companies, these are some names to take a look at over the next few days, regardless of the valuation metric they're sitting at right now. And for all the companies in the video, I do believe personally, and in my own opinion only, that over the next 5 years, they all should be larger with a higher market cap and a higher share price than where they are today. So although the valuations may seem crazy, I think these companies will all continue to grow. And I included Shopify in this Sunday's episode because the company's hosting their 2021 Developer Conference starting on June 29th. This is a major event where investors and developers all around the world will be tuning in to see all the new product launches and upgrades to the Shopify system over the next few years, and I think this can have a very good positive aspect on the share price over the next few days as well. And Shopify is a main player in the fast expanding e-commerce sector. Taking a look on the online sales in 2020, Amazon, of course, is the leader, making up 39% of the market, but in second place is Shopify with 8.6% of the total US retail e-commerce sales in 2020. So of course, Shopify itself is not making the sales, they're not the ones selling the product, but their platform is facilitating all the transactions made by the millions of different users and shops under the Shopify brand. So it's great to see that this young company that's still only valued at $183 billion is second to only Amazon in the e-commerce sector. Of course, Amazon does have a big lead, but we can see Shopify is actually above Walmart, eBay, Apple, and even Home Depot in terms of total US retail sales, which is a very strong sign. And if we take a look at the company's revenue numbers, they accelerate year after year at an incredible rate. Their annual CAGR sits at around 60%, which is absolutely remarkable, and total revenue in 2020 grew by 86% year over year to over $2.9 billion, setting a massive record for the company and surpassing every analyst's expectations. And we can see the dark green represents their subscription revenue. And if you're a subscriber to the channel, you know I'm a massive fan of subscription-based revenue because it's very predictable cash flow coming to a company month after month. And we can see the subscription revenue continues to grow for Shopify year after year as well. And taking a look at their latest quarterly performance, they grew 110%. Q1 2021 came in at $968 million of total revenue, growing by 110% over Q1 2020, which is absolutely remarkable. And of course, as I just mentioned, a key factor about Shopify that I believe makes it a very attractive investment is the growing subscription revenue. And if we take a look at that revenue over a quarterly basis since 2016, quarter over quarter, it continues to grow. In Q1 2016, their monthly recurring revenue was only $12.8 million. At the end of Q1 2021, their monthly recurring revenue is just below $90 million, meaning the company generates over $1 billion in annual revenue from their subscription model. And I do believe going forward over the next few years, quarter after quarter, this number will continue to grow to all-time highs. And we can see over the past 5 years, their monthly recurring revenue is growing at a CAGR of 45%, which is absolutely fantastic. And I personally believe the company's done a great job of also integrating their own products into the user market base. We can see Shopify payments have grown 135% year over year at the end of Q1. Shopify Capital grew 90% year over year, and Shop plus Shop Pay did see slight growth of 26% and then 7% year over year as well. So they are continuing to introduce their own products into the Shopify system and getting some of the largest retailers in the world on the platform using their own services. So overall, I think Shopify, even though they're trading at sky-high multiples right now, is definitely a company worth keeping your eye on. And because the company's hosting their 2021 developer conference this week, I included them in this Sunday's episode. And now we're going to continue on into stock number 2, and it's going to be ticker KMX, which is CarMax. They trade for $127 per share and are up by 42% on the 1-year chart. They have a market cap just over $20 billion with a forward PE ratio of 18.85. And over the longer term, this company has seen some incredible share price performance, growing by 175% over the past 5 years. And right now, the automobile and car industry has absolutely exploded and demand is through the roof and prices have continued to increase because of the chip shortage impacting the new vehicles coming to the market, and as well because public transportation is at record low in demand because of the pandemic. Individuals are scooping up used cars like crazy. So right now we're seeing a massive surge in used cars prices, which is a massive benefit for a company like CarMax. And going forward, the demand for vehicles is only expected to grow because even though the chip shortage is expected to come out in 2022 and 2023, we're still going to see an increased demand in vehicles because once people get rid of public transportation, a lot of people have moved out of highly dense cities into more suburb areas where they need vehicles to get around. I think the demand for used cars will be very strong over the next 12 to 24 months, which could lead to some great financial benefits for CarMax. And I included them in this Sunday's episode because they released their latest quarterly earnings on June 30th, 2021. We have a revenue estimate of $6.44 billion with earnings per share of $1.65. And this company is a massive player in the used car industry. We can see they're the largest seller and buyer of used autos within North America from consumers, and in 2020, they bought and sold 752,000 vehicles, way above all their different competitors. So right now they're by far the largest and currently have over 220 locations across the United States. And if we take a look at the company's financials, year after year, total revenue continues to grow. And since 2010, they've expanded their total top line by a CAGR of 11%. And if we take a look at their profits or the earnings per share, that continues to grow year after year at a CAGR of 16%, which is absolutely fantastic. And going forward, they have no plans on slowing down. And they're forecasting $33 billion in annual revenue in fiscal 2026, representing a 75% increase over the next 5 years from where they sit right now, which represents a CAGR of 12% per year for the next 5 years going forward. And if we take a look, over the past decade, they've been growing at 11%. So they're going to slightly accelerate their growth from 2021 through 2026, which is a great sign. So CarMax is the second company I've included in this Sunday's episode, a leader in the used car industry who's reporting earnings later on this week, and definitely a brand to take a look at. And now if we transition into stock number 3, we have ticker CRWD, which is Crowdstrike Holdings. They trade for $253 per share and are up by 139% on the 12-month chart. They have a market cap just above $57 billion and a very high forward PE ratio, which is a point I discussed right at the beginning of the video. And with CrowdStrike, they're a leader in the cybersecurity sector, which is poised to see annual expansion of over 15% per year for the next decade going forward. And this company itself has seen major expansion over the past 5 years, and it's been absolutely phenomenal. Taking a look at the numbers, this company continues to expand. They have annual recurring revenue of $1.19 billion, and 93% of their revenue comes in the form of a subscription, which is once again why I think this company is worth the high valuation and will continue to perform very well going forward. They have over 11,000 subscription customers. 64% of their subscription revenue is from customers with 4+ modules, meaning that people who sign up for one of their services are trying others and expanding their market base within the CrowdStrike system. And they've seen 73% revenue growth year over year, and their average recurring revenue, so the actual subscription-based revenue, has grown by 74%. And I included them in this Sunday's episode because on June 30th, they're hosting their 2021 annual meeting of shareholders, and every single time this company presents, the stock price goes up. They have incredible presentations. They share major updates on their business, and during all these events, they usually have so many good things that will allow for future outlook and growth of revenue and earnings over the longer term. So really looking forward to this event, and I will be tuning in to watch it live. And if we take a look at the numbers in more detail, year over year, their subscription customers have seen rapid expansion. 82% year over year growth to over 11,420 people. And we can see, as of April 30th, 2021, 61 of the Fortune 100 companies are using Crowdstrike. That's incredible. Over half of the largest and most powerful companies in the world are trusting Crowdstrike for their cybersecurity needs. And 13 of the top 20 banks are using this service as well. And of course, banks are the core leader of our entire financial system. We need the banks to be secure. If a bank gets hacked, that's going to cause problems for millions and millions of Americans and corporations all across the country. So the fact that 13 of the top 20 are trusting this platform shows that a lot of big major institutions believe in CrowdStrike and their services going forward. And taking a look at the revenue number, year over year from fiscal 2021, it grew 84% to over $874 million, which is absolutely incredible. And going forward in the first quarter, the subscription revenue grew 70% year over year to over $302 million. And taking a look, their rapid annual recurring revenue now sits at $1.14 billion. So every single year, if nothing changes, if they don't lose any members, if they don't gain any, their annual recurring revenue is now at around $1.2 billion, which is absolutely fantastic. And look at that, a 74% growth rate year over year. These numbers are insane, and it's what justifies the massive premiums that you have to pay to own CrowdStrike at this current point in time. And finally, taking a look at the numbers, going forward, this is a 5 to 10 year projection going outwards. They believe they can achieve a 30% free cash flow margin. A 30% free cash flow margin is absolutely amazing for a company like this. That's a ton of cash they can use to reinvest and grow the business. They don't have a lot of debt. They're not a capital intensive company, but to actually develop future products, remain as a market leader in innovation and research and development, having a 30+% free cash flow margin will do great things for the business. So overall, I think CrowdStrike is definitely another brand to take a look at. They are hosting their annual meeting of shareholders this week, and I think it will have a lot of good benefits that will really boost up investor confidence going forward. But also remember, I understand the high multiples on this company right now. Same thing with Shopify, and that's why I addressed it right at the beginning of the video. These companies are trading at high multiples, but we took a look at the numbers. They're expanding by 50, 60, 70% year over year. So of course, right now they may seem extremely overvalued, and I understand they may be. But going forward, if you believe the company's going to be larger in 5 years or 10 years down the road, then now might be a great opportunity to still buy in, even if the current numbers seem out of whack. So definitely a company to take a look at, and the third name included in this week's episode. And now if we move on to the fourth and final company we're going to take a look at in this episode, it's going to be ticker WBA, which is Walgreens Boots Alliance. They trade for $52 per share and are up by 24% on the 1-year chart. And although this company is not a growth player, they are a nice dividend company that offers some nice value at this current point in time. So they have a market cap at just over $45 billion, a nice high dividend yield of 3.6%, and a forward PE ratio just below 11, so much more reasonable than the first 3 companies we've taken a look at. We're also not going to get the growth that the other 3 companies could provide. And I included them in this week's episode because the company's reporting earnings on July 1st before the market opened, and we have a revenue estimate of $33.47 billion with EPS expectations of $1.15. And we can see over the past 4 quarters, they have 1 miss and then 3 consecutive beats, and we're forecasting 38% annual expansion in their total earnings per share, which would be a great sign for this company. And going forward over the next 2 quarters, another 17% expected growth, followed by 5% expansion in the first quarter of fiscal 2022. And if we take a look at their dividend scorecard, of course, if you were to buy into WBA this week, you're here for the dividend income. The yield of 3.6% is very nice in our current market environment when everything's at all-time highs and yields are getting smaller and smaller. They pay out $1.87 per share per year, and their current dividend payout ratio is less than 40% of their net income. And the company's 5-year dividend CAGR sits at 5.36%, so the annual dividend growth is outpacing inflation on an annualized basis, and they do have a very short dividend growth streak of only 6 years. And if we take a look at the company's income statement, although Walgreens is a name many investors try to avoid, I understand why, because it is a slower growth retail name. But if we take a look at their total revenue, year over year, it's actually growing. And a company's top line, if they're expanding that every single year, it means the company's operations are continuing to grow as well. So we can see $117 billion of total revenue back in 2016, then 118, 131, 136, 139, and now up to $142 billion in total revenue during the trailing 12 months. So although the company is growing at a slow rate, there is some growth on an annualized basis, which is nice to see. So definitely a more boring value type of investment to take a look at this week. They are reporting their latest earnings on July 1st, and Walgreens may be a boring company, but it might be worth taking a look at over the next few trading days. So I had to throw in a nice value play to kind of counteract the three major growth companies we've already gone over. So definitely keep your eye on the company over the next trading week. And now we're going to wrap up the video. I want to thank you for watching all the way to the end. Please hit that like button and subscribe if you already haven't done so. I'm the Gen Z Investor, and every single Sunday, I make a video going over the major headlines for the upcoming trading week. We discuss all the key earnings reports, all the major investor conferences or investor presentations, and of course, we discuss any big news that could impact the stock market over the next few days to give you a preview of what companies you should have on your watch list and which companies may go on sale or see some nice growth on a shorter term perspective. So thank you for watching the video all the way to the end. Please hit that like button and subscribe, and I will see you in tomorrow's episode.